Hi, everyone, and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds. And today I'm joined by the only person at Forager who makes me look not disheveled, Harvey Mogodi. Hi, Harvey, how are you?
How are you? Hey, I'm very good, thanks.
First up, congratulations. You've been with this business for a year and probably the clients haven't seen a huge amount of you, but you've had a huge impact on the fund's performance over the past year. Been recently promoted to portfolio manager. So on behalf of the client base and the business as well, thank you for your efforts and congratulations.
Thank you, much appreciated, yeah.
You're in the States at the moment for family reasons and also doing a little bit of on-the-ground research. What are things like in the US at the moment?
Well, I've been kind of spending my time between Nevada and California, so between LA and Vegas for the most part. It's been really interesting. So Vegas is doing really well. A lot of people are wearing masks. Everything indoors requires you to wear a mask if you want to go into a shop or a restaurant. There's spacing between tables when you go and eat. It's done really well. In the casinos at every entry point, there's a person that has masks to give you if you don't have one, and just is enforcing these rules. So it feels pretty safe. They even have like plastic barriers between the blackjack tables, so like you actually have some sort of protection between you and the next punter. So that's been interesting. And I think, and that allows you to keep going and not have to lock down fully. So I think they're doing that really well. People are even wearing masks in the streets. So, you can question whether that's helpful or not, but they're doing it here. So that's been interesting. LA, a bit less so. They've totally locked down, but I don't quite, now they're mandating masks, but it just feels like maybe, they've gone a bit too extreme, but then again, they have had a bigger issue with COVID as well. I had a chance to do some diligence on one of our favorite investments, Celsius.
Yep.
It's been really interesting. I visited a number of retail and grocery stores. Their
Just really quickly for the people who haven't read the quarterly report, this is I guess a healthier version of energy drinks, really rapidly growing business that we've had in the portfolio now for maybe 8 or 9 months. The stock price has done really well, but we're seeing some really good numbers out of it as well. And yeah, you've been out visiting a few stores and seeing where it's turning up on the shelves.
Yeah, I mean, it's been great, since I've been here 1 or 2 years ago. I don't remember seeing their products on the shelves much, but they are all over the place in terms of Sprouts and Vitamin Shop, etc. And they've got actually really good shelf space, so kind of eye level. They're in the coolers by the checkout stations and so forth. And it's great to see that happening. And the Nielsen data that we track supports that. The company's sales over the last few months have grown between 40 and 60%, which is just fabulous, given that last year was already strong. So very, very positive on the outlook here for this one. Obviously, it's starting to get priced in. It's done very well, but there's a ton more growth to be had here, and the stock will continue working as long as the company continues growing, I feel.
Yeah, that's great. It's a US listed stock, and I think one big benefit you've brought to the portfolio over the past year is a lot more US exposure for us, a better balanced portfolio, also a lot more liquidity in the stocks typically that you're looking at. And where in general does your experience and your ideas come from?
I mean, it varies. I might generate it from just reading a newspaper and seeing some sort of angle about something happening within 5G or Wi-Fi or whatever. It could come from brokers. It could come from other investors, blogs, and so forth. I mean, I have a pretty decent bench of higher quality names that are growing that I still think are attractively valued. And, we're pretty lucky to be able to pick some of them up over the last 12 months, particularly during this turbulent period in March. So, obviously we popped Zebra into the portfolio as soon as I joined. Autodesk and CDW were additions during the meltdown in March, which at really attractive prices, and Autodesk in particular has done really well since then. So really great to have a bit more of that in the portfolio. I like these kind of market leaders that are still where the price discovery is still happening by the market. I think our impress on Zebra was 14 times earnings, which is really amazing for a company that controls 50% of the market that they're in, and is growing and continues to grow rapidly and has a long runway ahead of it. So that's generally the pond I like to fish out of, so to speak. But more recently, given the team's expertise in the smaller cap space, I know you guys have encouraged me to look there, and that's how some of these really interesting ideas like Celsius have cropped up in our holdings. So they've also done really well. So kind of trying to play both sides of it, keep a balance, and move around where the market's not looking, ideally, if possible.
Yeah, I think that blend is working really, really well. Taking that, I think, industry and in-depth knowledge that you've got and trying to find the business that's maybe a little bit less covered, where we make multiples of our money. I think that blend in the portfolio is working really well. The last time we had a really good year like this past one was 2017, and we went into 2018 with a lot of cash because a lot of those ideas had worked out, and that was not good for us into 2018. As we sit here today and look into 2021 following another really good year, I mean, how are you thinking about the portfolio and the prospects for this coming year? And I guess, how do we ensure that we don't repeat that mistake of 2017?
Yeah. Look, I think it's important to constantly be assessing how your investments have done and what the upside is. So, we added Spotify to the portfolio at the end of last year, and it doubled for us. We've already exited that position because we think that the risks perhaps now outweigh the upside left in the share price. That being said, there's still a ton of opportunities out there. Obviously, a lot of the cyclicals have been gutted. A lot of these stocks, such as even Zebra and CDW, still have a lot of upside, and yet the market is a bit nervous about them. So, there's pockets such as cloud and some of these tech names that are that have gone through the roof and ballistic. Afterpay being an example in Australia, but there's still plenty of juice left in the tank in some of these other names. And we've obviously been recycling some of these ideas. So as I said, we sold Spotify. We've got a bunch of new ideas that we've popped in over the last 2 months that have yet to materialize in terms of their returns for us. So I'm actually really excited about the coming 12 months. I think we've moved the portfolio around pretty quickly, and we've got some really good names that still have a lot of upside left. So I don't
said a few times over the past
the lemon out, so to speak.
Yeah, I've said a few times over the past couple of months that the dispersion out there in sentiment towards stocks is really positive, I think, for stock pickers, because there are pockets that people are crazy about, and there are also pockets that they don't want to touch it at pretty much any price. Maybe can you give us an example of one of the new stocks that we've put into the portfolio recently that you're quite excited about?
Yeah, sure. So we recently added a name called Open Lending, which came to the market through a SPAC, i.e. it reverse listed, so it didn't do a proper IPO, and that gave us a really interesting opportunity to pick it up with.
Just really quickly for Australian investors, these are US listed companies that have raised some capital into a shell, and then they basically backdoor list an unlisted company into that shell. So it's sort of a way of doing an IPO with a little bit less risk, but you end up with a company here coming to market into a shell. And it's been a pretty popular way for companies to come to market over the past 12 months.
Yeah, it's been a really hot space as well. DraftKings and some of these other names have done extraordinarily well since they've reverse listed. So look, this company is really interesting. It's in the US, you're either a prime borrower or a subprime borrower, and there's kind of not much in between. So as a prime borrower, you're getting really good rates, whether it's on mortgages or on cars or whatever. And as a subprime borrower, you're paying a ton of money away and a high interest fee to the banks. There's also obviously a higher default risk. So what these guys do is they have internal systems and algorithms, and they help auto lenders match themselves with near subprime clients. So this huge pocket of people that are just below prime, but much better than low subprime. So very low chance of default, but you can still extract a decent rate from them, and they're playing in this little niche. Very exciting company, growing 30, 40, 50% year on year. They've been around for 20 years. Tremendous growth over that period. Just listed, so they're new to the market, and obviously they're playing in a space which investors are nervous about. Car loans, auto loans, and that has given us the opportunity to buy the stock at what we think is a very attractive valuation. It's already done pretty well for us. Our in price is kind of 15, and it's trading at 18 now. We think there's a lot more room left for the stock to run. Very excited about it. Obviously, we need to watch the cyclicality. We need to watch consumer sentiment and just make sure that, auto values and so forth don't collapse, particularly in the US. But as long as that holds firm, this company should do really well. So,
yeah, the intellectual properties The intellectual property is really interesting here. I think a really good asset. And one of the things that I like about these SPACs versus your typical IPO is that often the founders of the business keep very significant stakes in the listed entity post-listing. And we've got that here, that there's still a huge amount of skin in the game, a big market opportunity. I think, like you touched on, for people willing to put up with the volatility in the short term, I mean, we don't have any better idea than anyone else about what the next couple of quarters look like. But I think looking out 3 and 4 years, it's a really exciting business. And you touched on this before, but I think it is a perfect example of this market being far less interested in things that have a little bit of uncertainty about them, and you're getting very, very well rewarded for taking that on.
Yeah, it's funny because if I gave you the metrics that the company is doing, i.e. the growth, the margins, the outlook, and so forth, and I didn't tell you that the end market is auto lending, you'd run out and buy this, and this thing would double overnight. So that's given us this opportunity. We're going to have cycles. Of course, we're going to have cycles with whether it's auto sales or auto loans or mortgages or home building or whatever. But given our holding period, where we can take a stock through that and hopefully see it grow. So hopefully it does well for us. Fingers crossed. Let's see. It's new to the market. There's still very little history as a public company, but so far so good. Hopefully.
All right, that's great. Thanks a lot, Harvey. Good luck over there in the States. We'll see you again in a couple of weeks for our roadshow. Don't forget to register for that if you haven't already. It's hopefully going to be a very good event, and we've got a format in store online here that we hope is going to be at least as good as in person. Thanks again for your time, and we'll see you next week.
Bye-bye.